Hello everyone and welcome back to another week of analysis regarding fundamentals and technicals in the Forex market. Now, this week's analysis is deliberately delayed due to some interesting news announcements that are coming out specifically today. So it would be good if by now you would watch the calendar knowing that these things are coming out. So we started out the week with some safe haven yen strength. And that's basically due to the stock markets and equity markets still falling, although they have recovered since then. Just a quick note here before we jump into the whole analysis part of the fundamentals is that the yen basically powered up, and if you remember, we talked about the 108 level as a good buy scenario. Well, it turned out that the yen strength, so-called, this has been labeled by now as a very light flash crash, which is a bit too big of a headline for it, because these moves are something that can be expected, especially at the start of the year. But that said, we came onto the 105 level and then managed to reject all these levels and then stop around the 108. And there's no basically, it's not a coincidence that we stopped at the 108, because that's where we have the previous support, and that's where the 50% Fibonacci lies when it comes to technicals. At the same time, the 108 buy scenario would have been much more feasible if we have a very structured sort of normal market cycle sell-off and then a clear rejection, which would have been in a normal volatile market. This was an out of ordinary sort of sell-off. So this pin bar, although it qualifies as a pin bar on the weekly and the daily, it basically makes us question whether this is something that will be sustained, or whether if it's something that will head further down low and then make another double bottom or another find another support. And the evidence to that is that you can basically see how this bullish buyback did not result. We're in the middle of the week and we still have not managed not even to push prices up with 50 pips. So that's a clear sign that that strength that was originally there, it was basically a lot of diversifying into the yen, people getting into the yen, and those who were in from higher above at better prices at the 112, 113, they basically took some of their positions and they short covered and they took some profit. And so that's really why this pin bar candle happened. It formed, and so it's not as relevant if we would have normal market conditions. So jumping into fundamentals, because clearly if you look through the pairs, they are lacking any sort of structure technically. Jumping into the fundamentals, what's important is that the last week on Friday we had the NFP report. Now there's a lot of chatter around since that ISM manufacturing has been declining, that productivity growth is slowing down in the US, and instead of the economy expanding, it's actually going to be contracting going into the second half of 2019, and this will basically make the Fed stop its rate hike cycle and even possibly reverse, which many would call a quote-unquote disaster and a basically a borderline recession. So at that point, what we can do is we are basically watching this data, and then ISM manufacturing came in below expectations, and then the day after, the NFPs, which is again a number and figure measured throughout the economy, the US economy, to gauge future monetary policy and whether the economy is contracting or expanding. What we can see is that non-farm employment change added plenty of jobs. Average hourly earnings did increase to 0.4%, but then the unemployment rate ticked up 0.2%, which is a huge month-on-month difference from 3.7% unemployment rate to 3.9%. So despite adding jobs, despite good average hourly earnings, you could say that that was offset due to an unemployment rate that was higher up. And this sparked also Federal Reserve Jerome Powell being more cautious in his tone. And so that's really today's what it's about, because we're expecting the FOMC meeting minutes. So those meeting minutes will shed more light, and I believe, given the fact that we had some volatility, and now from Monday up until today we had low volatility, this Fed FOMC meeting will again, depending on the language, will step into a more volatile zone and area here on the dollar index. And depending on what they say, depending on whether they are putting their foot on the brake when it comes to the rate hikes, this will determine where the dollar is going. Hence, it will determine where the pound, euro, and all of these will be driven. At the same time, just hours before, we will have the Bank of Canada's rate statement and the rate decision. And again, a lot of speculation here. Overnight rate expected to remain the same at 1.75%. But what's interesting is that just 2 days ago, everyone was looking at 2% on the overnight rate, which means that a hike of 25 basis points was expected. That expectation sort of got erased within the week. Nonetheless, the Canadian has been powering up, and this is one of the trades that we were looking at in case we have a lower high. We did not have a lower high, so there was no reason for us to sell at the lows of the intraday or sell at the lows of the daily. Even though we would have made some percentage there, it's just better to wait for a value price, and if it's not there, then there's no reason to trade. And so this overnight rate, again, depending on not just the overnight rate, but also the rate statement, because everyone is going to be looking whether the previous comments from Jerome Powell, the Fed chair, that was scaled back, that had some more caution in the language, and they're going to be looking whether the Bank of Canada follows suit, since they had the rate hike part very parallel to the US. That said, Citibank's outlook on the dollar, it says here that the dollar may more than reverse this year's rally over the medium term. And they expect that over the 2 years, the dollar trend to reverse with approximately 8% to the downside versus the G10 Forex major pairs, and around 2 to 3% weaker over the next 6 to 12 months. Now, 2 to 3% doesn't sound much, but if you factor in the other fundamentals from other pairs, which could actually be positive, then you'll see a much bigger rally on, such as, for instance, the euro, such as even the pound, if Brexit is going to be sorted out, or at least some light at the end of the tunnel actually occurs. Not to mention the commodity-based currencies, the Aussie, the New Zealand, despite being very dollar heavy, they could still rally against the dollar. And so the reasoning in the background for this dollar weakness on the medium and long term is, one of them is a flatter, especially inverted yield curve. We know that the yield curve plays a major role, and we go into this in more detail in our advanced course. And then that flatter yield curve may be a precursor of weaker economic growth, which may undermine the dollar. The second reason is that the Fed may end the rate hike cycle altogether next year, while other major central banks may tighten the policy gradually. So we've had the US first coming out and really starting the rate hike cycle, where everyone else was halting and not really having been able to hike rates due to low inflation. Now the Fed is sort of had its cycle within the 18 months, and now it needs to sort of stop, because if not, then it's going to hurt the economy. The fact that they hike rates, even though inflation is not there where it should be, and the economy is not expanding. So while they halt, right, then the other economies will basically come in, and the other major economies will come in, and they'll be able to hike rates. And despite the lag, despite the time difference, no one really cares that the reason why the Fed hiked is because they might be the first to see an expanding economy. The fact is, right now, other economies are expanding and US is contracting. So that will be translated to the charts in a matter of dollar weakness against any other major pairs, such as Aussie dollar, Canadian, euro, seeing some upside against the dollar. And so that's really what we're looking. And the third reason, US growth slowing, dovish Fed, skepticism about global recession may point to dollar weakness according to past experience. So this is again something that it's too early to tell, but the way things are set now, they are set for that, basically for the US economy to not look good going throughout this year and even next year. Whether that's changing in the next 6 months, whether it's changing in the next a year or so, it's something that we don't really know. What we know is that right now we need more clarity on all of these pairs. So the best ones to trade at this point are the crosses, because the major pairs are not offering enough for us to be able to capitalize on anything. And so when we look at the actual day-to-day weekly outlook, is we had the Euro Canadian trade that worked out quite nicely at just above 2% from the 154, having had a short trade on that. So again, pullbacks into that, retraces, so we can sell at another lower high is expected, but again, did not materialize this week. Could do so due to the Canadian Bank announcing the rate hikes and the Canadian dollar behaving either negatively or positively. We could see this lower high being formed on the intraday. Euro Aussie at the same time, same thing. We are waiting for that lower high, and so I can flicker through these, and all of them will have some of the same scenario where we have a clear rally without a pullback, and then the pullback occurs. And so there's two ways to play it. Either we play into the pullback if it has a chance to reverse altogether, or we are waiting on a pullback to be able to buy it back. Now, one of those pairs was a dollar Canadian, which I mentioned that the 133 will be a key level from which we could buy the dollar Canadian. But since then, that has changed due to the Canadian strengthening because of this expected rate hike, the US slowing down, and the Fed coming out with some more cautious tone. And if that continues today with their FOMC meeting minutes, then obviously we will see further downside. So this initial plan of the 133 would have been the case if the fundamentals would have remained in that same outlook what they were at the start of the year. Unfortunately, they changed, so we have to be flexible and change our trading outlook as well. So for now, that 133 still remains as because again, we don't know what the Canadian does today, we don't know what the dollar and the Fed does, so we could see a bullish engulfing closing above the 133, which would make us for a good trade by the end of the week. But again, there's no way to know. However, if there's no such thing occurring, then again, the lower high will be our best bet, depending on where this pullback will stop, and then retrace to take some profit. Don't forget, markets move in cycles, and cycles will always have lower highs and higher lows, which means that sooner or later, those who sold at the top, because to be honest, they did not sell at they sold at value, but they did not sell at clear confluence. So those who sold at value will sooner or later start scaling back, start basically taking some profit just to cover themselves, and then that profit taking will initiate some buyers coming into the market, usually the amateurs, and then that will instigate a lower high. Once we have the lower high, it will usually align with the previous support or resistance, and then we can look for another position to sell. And it should be the same on the Euro Canadian as well, and even the Euro New Zealand. I remember putting a alert on this one. So again, similar situation, but again, you can see the range, you can see the low volatility. There's not a lot to go on technically on these markets. Again, very a wedge that it's clearly doesn't have any clear direction. And price is squeezing on this pound dollar as well. So usually what I like to do is I like to have a clear list of possible trades that I'm going to take. But this week, due to this sharp volatile movement at the start of the week, due to that supposed quote-unquote flash crash, every other pair just went into this low volatility sideways movement, making us basically unable to take high quality technical trades, and then be able to see how the fundamentals will affect it. So we have to sort of play the other way around, where we look at fundamentals and see if the fundamentals of today, of anything that's out throughout the week, will basically give us a technical signal. I'm usually more of a fan if it happens in the other way around, where I have a technical signal and then there's a fundamental supporting that. but it is a cycle in which basically whichever happens quicker is the one to go with. However, I would never take a trade based on fundamentals only without a technical signal. So that's just to keep in mind. That's a very clear rule in our trading method. So any questions, let us know, and that's really it. See you next week. Have a good one and happy trading.